Well, good afternoon and welcome to the Inflation Reduction Act and CHIPS Act updates. So as many of you are aware, the Inflation Reduction Act was passed on August 16th of 2022. So it's now celebrated its first year anniversary. And the CHIPS Act was passed on August 9th. Two major pieces of tax legislation dealing with energy and alternative energy expansions in regards to credits. So my name is Ron Wainwright. I'm a tax partner and leader of our energy practice for Cherry Bekaert, and we thank you for joining our webinar today. So from what we will cover today, I wanted to go through the agenda. First, we want to talk about the Inflation Reduction Act's purpose and its impact to date. We want to talk in more detail around the energy tax credits and incentives that are available to taxpayers who are considering or are implementing a number of provisions that are contained in the Inflation Reduction Act. And then we also want to cover the CHIPS Act, or often referred to as the Semiconductor Act, where over $100 billion of public-private announcements have already occurred since August 9th of 2022. So I want to make sure that I introduce the speakers today. I have with me some teammates that you will be hearing, myself, and then Tim Doran is a director in our energy practice, and David Mahimi is a manager in our energy practice. Both have significant experience of over 8 to 10 to 12 years in regards to practicing in the energy field. So this brings us to our first polling question. How did you hear about this webinar? A Cherry Bekaert tax advisor, an email from Cherry Bekaert, a friend or a colleague, Cherry Bekaert alumni, or one of our social media posts? And while you are completing the survey, I would mention that we have over 100 thought leadership positions out from Cherry Bekaert, as we hope we are one of the leading and premier energy practices throughout the United States. So we'll give you another minute to complete the poll, which is obviously important for, quote, CPE, and then we'll post those. And then I did have in the chat, and so I want to thank that individual who indicated that none of the above. They actually looked it up in regards to our external. So an email from Cherry Bekaert, 69%. And for those of you who saw it from a social media post or others, we thank you, or may have read one of our thought leadership positions. So what I'd like to do now is turn it over to my teammate, Tim Doran. And Tim's going to take us through the Inflation Reduction Act and an overview from a historical perspective, as well as some of the more significant changes. Tim?
Hey, thanks, Ron. Thanks for that introduction. As Ron mentioned, my name's Tim Doran. I'm a director here in Cherry Bekaert's energy practice. A little bit newer to the firm, but not new to tax and not new to energy. So I'm really excited to talk with you all through the Inflation Reduction Act today. To echo what Ron said and to manage expectations, we're going to reintroduce some of the key concepts that are in the Act, talk about some of the credits to refresh our memory, but we're also going to have a focus in this presentation going forward on reflecting on where we are a year later. So without spoiling too much, we're going to look at a real-world case study after I start to walk through the background of the Act and then also what it includes. A little over a year ago now, the summer of last year, we were wondering if we were going to get an act. There were several different pieces of legislation that had been introduced. And then because of the political climate in the United States Senate, it looked like they might be dead in the water. And then lo and behold, just over a year ago, on August 16, 2022, we got the Inflation Reduction Act. It came out of a little bit of drama, but it ended up being a large change to clean energy investment in the United States of America, hundreds of billions of dollars in spending, and it made a lot of potential favorable benefit available to taxpayers interested in clean energy. It included tax credits and incentives, research and development tax credit extensions, and also 4 key revenue raisers to pay for the act that we're going to briefly talk about. So we introduced new and expanded tax credits. So that's important. We got both new tax credits that weren't previously available prior to the Inflation Reduction Act, but we also continued on with some credits that were expiring and then enhanced those credits as well. And we're going to talk through all of those. In general, the Inflation Reduction Act focused on particular technological areas. It's very broad, but those are clean technologies that include everything from solar and wind to geothermal to carbon capture, and then even additional credits that we'll talk about for companies and individuals manufacturing components that go into clean energy. Before we get there, though, we'll talk a little bit about how the Act raised revenue. So as I mentioned, there were 4 key provisions for raising tax revenue in the Act. One was an extension of 460L, which was the excess business loss disallowance and forced you to have an NOL carryover. That was extended until 2029. The Inflation Reduction Act also reintroduced a corporate alternative minimum tax on book AMT. That started in 2023, but it only applies to domestic C corporations with 3-year average financial statement income of more than $1 billion. So the actual number of companies that applies to it was somewhat limited. The Act also put a new 1% excise tax on corporate stock buybacks for companies looking to repurchase their own stock from their shareholders. And then finally, famously or infamously, the Act also sought to raise additional revenue by increasing the budget for the IRS, about $79 billion over the next 9 years. So let's jump into some of these actual tax credits and incentives. Some of these, we'll go through a little bit briefly. We're gonna, as I mentioned, we're gonna have a case study that really focuses in on some of the meat and gravy of this act, but did definitely want to give coverage to a lot of these different tax credits and incentives that are out there. So you'll see there's Section 45L, which provides a tax credit for construction of new energy efficient homes, $2,500 for new homes meeting Energy Star standards, and $5,000 for certain zero energy ready homes designed specifically to benefit home builders. There's also some key updates made to Section 179D that a lot of taxpayers we find take advantage of with respect to the deduction for energy efficient commercial buildings. The Act had an increase of the maximum deduction to $5 per square foot for qualified buildings. It reduced the qualifying threshold of calculated energy cost savings from 50% down to 25%. It gave the ability for a tax-exempt owner of a building to allocate a 179D deduction to an eligible designer of the property, and there was a 3 to 4 year reset, allowing a deduction to be claimed multiple times for a building, so long as relevant updates were made over that period. And that brings us to polling question number 2. Were you aware that you could reapply for the Section 179D deduction every 3 years now? I think as people answer that, there's a question regarding energy storage, which is an awesome question, and we are gonna talk about that. The Inflation Reduction Act did have an impact on how we can get tax credits for energy storage, especially standalone energy storage units. So more to come on that. Oh, so it's like a substantial portion we're not aware. Yeah, that's a nice benefit for taxpayers there under 179D now. All right, we're going to keep kind of quickly going through some of these other extended energy tax credits that were found in the Inflation Reduction Act. We had Section 40 Cap A, which was an extension of $1 per gallon for biodiesel and renewable diesel used as fuel through December 31st, 2024. We had Section 30 Cap C, alternative fuel vehicle refueling property, a credit of 30% of the cost of any qualified alternative fuel vehicle refueling property to those placed in service before January 1st, 2033. And this is where, as I mentioned, we're getting into a little bit more of the meat and gravy. We're going to talk a little bit about the investment tax credit. The investment tax credit existed in a somewhat similar form under the prior regime before the Inflation Reduction Act. And the investment tax credit gives a federal tax credit for the basis of property placed into service that meets certain qualifications. So under prior law, the ITC began phasing out for certain projects beginning construction after December 31st, 2019. And there was a phase down scheme that existed. So depending on when you place that property into service and started on construction of the property, you might have a varying amount of credit. Under the new regime in Section 48, we have a concept of a base credit, which is 6% of the basis of the qualified energy property, but that credit can be increased up to 30% and more depending on whether or not projects meet certain qualifications that are included in the code. And we're going to talk about that. The technologies that are now eligible for the investment tax credit are various, from fuel cell, solar, geothermal, wind, energy storage is one of the questions asked, and that's standalone energy storage now. Biogas, microgrid controllers, combined heat and power properties, and several other ones that are now eligible for this pretty substantial tax credit. So this credit goes against your federal tax liability in the year the property is placed into service. It is subject to a recapture period. So there are certain rules that must be made, including the sale of that property, which can cause that credit to be recaptured by the IRS. It's also subject to the general business credit limitations and restrictions that exist elsewhere in the code, including the carryback and carry forward rules. And we talked a little bit about the technologies that are available for the investment tax credit. Section 48 had a couple of other interesting provisions that were included in the Inflation Reduction Act. One of those was Section 48 capital C, which is an advanced energy project credit. This provides a transferable credit for certain investments in advanced energy projects. And we also had Section 48 Cap B, which was another credit for clean electricity investment. Kind of the brother or sister to the investment tax credit is the production tax credit. The general concepts around the credit are similar. The types of technologies that qualify for the credit are very similar. There was also a prior schema that existed under the pre-Inflation Reduction Act regime that included a production tax credit, but the new Inflation Reduction Act expands it, right? And so now we've seen production tax credit applying to new areas of technologies like solar, and essentially what the production tax credit does versus the investment tax credit is it gives you a credit based on the amount of electricity you're producing and selling from your investment. Unlike the investment tax credit, it's recognized over a 10-year period beginning on the date that the facility is placed into service. And there's also an annual inflation adjustment included in the code. And it's important to note, and because we see this question come up sometimes, the investment tax credit and the production tax credit are an either or thing per facility. So you cannot choose both tax credits. It's one or the other. A couple additional provisions that came out under Section 45, which was the general production tax credit code, was a zero emission nuclear power production credit, a transferable tax credit for electricity sold from qualified nuclear power facilities at 3 cents a kilowatt hour. The expansion and extension of Section 45 capital Q, which is a credit for carbon oxide sequestration. Carbon oxide sequestration applies to various technologies that take carbon out of the atmosphere and store it indefinitely. We also have a new Section 45 capital V clean hydrogen production tax credit for producing hydrogen at a qualified clean hydrogen production facility, and a Section 45 capital W credit for qualified commercial clean vehicles, which provides a tax credit for purchasers of certain qualified commercial clean vehicles. Continuing on, we have Section 45 Capital X, Advanced Manufacturing Production Credit. This is a really powerful credit for manufacturers of components that go into these new clean energy technologies. There's a long list of different credit rates that vary versus the technology. It also includes tax credits for the production of critical minerals used in these different technologies. There was obviously a critical component of the Inflation Reduction Act was trying to domesticate a lot of this manufacturing and production. And so this credit is focused on United States manufacturers who are producing these components, solar wind modules to inverters to wind energy turbines. We also have the Section 45 capital Y Clean Electricity Production Tax Credit. This is a new concept going forward, which will begin in 2025, and we'll talk about this a little bit more. But there's kind of a transition period under the extension of the investment tax credit and the production tax credit that's going to move into a new tech neutral tax credit. So we won't be as worried about the underlying technologies which make a certain property eligible for these tax credits. And this is reflective of the fact that there was some discussion in years past for those who are familiar with why certain things like going back to the standalone battery storage, why they wouldn't be eligible. And part of that was that Congress, both Congress and the IRS, weren't able to predict all of the new technologies that would become both available and readily manufacturable in the future. And so the concept of Section 45Y and its counterpoint in its investment tax counterpoint are to provide a tax credit for any types of electricity generated from renewable sources that have a net zero carbon output. And then we also have Section 45 capital Z Clean Fuel Production Tax Credit, which provides a tax credit for domestic production of clean transportation fuels, including sustainable aviation fuels. All right, now we're going to get and talk a little bit more about what kind of specific things the Congress decided to provide to enhance some of these previously existing tax credits. As we mentioned, there's a 6% base credit, but conceptually, provided you meet some of these new rules, you really get a kind of base credit for your technology of 5 times that, or a 30% credit. And we have 2 important requirements that Congress put into the code. One of them is a requirement for prevailing wages, meeting prevailing wages on your project, and we're going to dig into that a little bit. And the other one is meeting registered apprenticeship requirements during the construction of the project. In addition to that multiplier for your base credit, we also have some adders. And so the true potential of your credit could be as high as 70%, because the way these adders work is if you had a 30% tax credit, so remember that's 30% multiplied by the basis of the property you're placing into service, these adders add to that. So if you met the facility domestic content requirement, you have a 40% times your basis credit, and you can continue to add in these extra credit rate increases provided you meet the various requirements that Congress provided. The next one, so we talked about domestic content, and we'll dig into that a little bit more. There's also an adder for placing your property into service and what the Congress has deemed to be energy communities. There is a particular credit increase for solar and wind facilities with a maximum net output of less than 5 megawatts that are located in low-income communities. And then there's also a 20% credit increase for a project that's part of qualified low-income residential building projects or qualified low-income economic benefit projects. All of those having been both defined by the code and continually their definitions have been refined by notices and regulations that have continued to come out from the IRS and Department of Treasury. So let's talk a little bit more about these prevailing wage requirements and apprenticeship requirements. And we're going to see how these operate when we get to our case study, but they're really important that taxpayers meet these. And even though developers might have their hands close to who they're contracting and subcontracting on the creation of any of these particular qualified projects, ultimately the taxpayer, whether they're the developer or not, is going to be the one responsible for making sure that these requirements were met. And so they really apply to anybody looking into clean energy. The prevailing wage requirements require that any laborers or mechanics employed on a project must be paid prevailing wages as determined by the Department of Labor. And there's also a requirement that apprenticeships on the project meet a percentage of total labor hours for the construction, repair, and alteration of any energy facility subject to these credits. So prevailing wages, we've already gotten some guidance from the IRS in late 2022 in notice 2022-61. And that requires that taxpayers meet the wage rates, that they maintain documentation that they met all of those wage rates for all the individuals subject to the prevailing wages requirement. Those rates start at the start of the project, and they combine the hourly wage rate with fringe benefits rate paid to workers. And the Department of Labor publishes some of these prevailing wage determinations, and there's specific guidance on how you can go about finding and making sure that you're using the right rates for the right laborers. And it covers from construction through alteration and through repair of the project as the project is being placed into service. A key note here at the very bottom of this slide, though, is that there is a provision in the code that allows the taxpayer to correct deficiencies. So while you want to make sure that you're meeting these requirements and maintaining documentation, there is an out if there are any issues that arise. Similar slide for the apprenticeship requirements. We got the notice in late 2022. It requires taxpayers to track labor hours, apprentice participation, and record all of those records. There's a different percentage for how many qualified apprentice hours you need on a project based upon when you begin construction. So now, that we're after December 31st, or once we get past December 31st, 2023, that rate will go from 10% to 12.5% and then to 15% going forward. Similar to the prevailing wage requirements, there's also a good faith exception. And what that essentially says is if you go out and try to find apprentices through a registered apprenticeship program and you are unable to do so, then you can be deemed to have met this requirement. Domestic content. So if you rewind a few slides in your heads, remember there are these adders. So the prevailing wage requirements and the apprenticeship requirements we just talked about were to get your multiplier, your 6% times 5 to get to your 30% credit. Now we're getting into these adding 10% for domestic content, these adders for increasing and enhancing your credit. And we've also got new notices this year on domestic content. But to meet this 10% bonus, the steel and iron used in your facility must come from the United States. 40% of costs for qualified energy production must be from US-made components. And then there are some separate requirements for offshore wind facilities and those increase over time. Energy communities is another one of the adders, which we also got a notice on, giving us a little bit more clarification. There are several different types of definitions for these energy communities. One of them is brownfield sites, which are communities involved in the extraction, processing, transport, or storage of traditional fossil fuels. There is a identification for these energy communities through communities with unemployment rates at or above the national average for a previous year. And then we also have a census tract where a coal mine closed after 1999 or a coal-fired electric generating unit was retired after 2009. The low-income communities is another adder that provided for a 10% increase for solar or wind facilities that are installed in these low-income communities as defined by the code and subsequent notifications, or on Indian land, and a 20% increase in credit is available in very specific situations for eligible solar and wind facilities that are part of what are called, quote, qualified low-income residential buildings, or provide at least 50% of the facility's total output to qualifying low-income households. All right, that leads us to polling question number 3. Are you aware that energy tax credits and incentives can be used in multiple ways to help your business? Oh, 64%. Yes. Yeah. Awesome. I think we're definitely seeing over the course of the last year, and this is where, this is the timing for our year update on these types of materials where at least the awareness within various markets is coming on board that, hey, there's substantial tax credits, more so than there have ever been with respect to clean energy, and there's some opportunities out there. All right, potential impact. So we're going to get to that case study. We talked about it, and Ron, I'm going to turn it over to you.
All right, Tim, thank you so much. To Tim's last comment, what we are seeing is, of course, as you saw through the revenue procedures, the IRS continues to give us what I would refer to as interim guidance in regards to a number of areas. I would also refer to the participants. We've written a number of thought leadership positions in regards to the guidance, specifically and most recently, the low income, as well as we've also done domestic content and then prevailing wage and apprenticeship. We have another thought leadership position coming out. As I answered a question in the chat, that was very much a policy platform within the Inflation Reduction Act. So what we thought we would do, because there's a lot, 2,700 plus pages in the Inflation Reduction Act, and of course we'll talk about the CHIPS Act or the Semiconductor Act later. But what we wanted to do was kind of tie it all together. And so we, as an energy team, do a significant amount of modeling with respect to taxpayers, clients and non-clients, to assist them in evaluating a business case. And so we thought we would just spend some time showing you how it all comes together. And so here's our scenario in our business case. We have ABC Solar Company, which is investing in a solar project that includes an array of solar panels, and to a question that came in, also a battery storage component. So yes, we are seeing more and more analysis as well as taxpayers putting in battery storage, and often we see that evolving to what is referred to as a behind-the-meter microgrid process. Remember, as Tim covered, we saw an increase first time in the Inflation Reduction Act to where now a battery storage qualifies for a 30% credit. We'll talk about that in our business case. In this case, the project is expected to qualify for investment tax credits. Obviously, Tim covered the basis analysis of the 48 and then production on the 45 side. So our construction is expected to begin in 2023. For our fact pattern, construction will begin prior to or post the January 30th, 2023 date. So when you think about prevailing wage and apprenticeship, when you read the thought leadership position, as well as you look through the guidance, you will see that any project that began construction, I often refer to it as shovel is in the ground prior to January 30th of 2023, is grandfathered into the prevailing wage. So though prevailing wage takes us from 6 to 30%, you can be grandfathered if the construction began shovels in the ground prior to January 30th of 2023. So in this case, we're post that, just to be clear. So what does ABC want to do? It certainly wants to meet the prevailing wage and apprenticeship requirements, and we'll dig in to how that occurs so that they can increase that base credit of 6% to 30%. If you are not in the grandfather provision, as well as you don't cure various analysis that are required, then you're going to fall back to that 6%. And then, of course, we want to make sure that ABC Solar Company, as we are modeling the business case for them, that we're really checking if they qualify for all the bonus credits that can take us, at least in solar, to the business case from that 6% all the way up to a potential 70%. And that obviously does not take into account the depreciation. So remember, a solar asset is a class life of 5 years. So that's going to qualify for bonus depreciation. So let's go through kind of the case study around the prevailing wage since we're post that January 30th date. So remember that the wage and hour division of the Department of Labor post labor classifications, and those are very specific by job type, and the prevailing wage rate in sam.gov. So it can be easily looked up. You use this information to determine how and what wages are going to be paid based on the state, the county, and the construction type. So there's really three areas that we're looking at when we look at the Department of Labor requirements around prevailing wage. And so remember that it is determined based on where the asset is in fact located. In our example, ABC Solar is classified as heavy construction. So that goes into the construction type is also going to dictate the prevailing wage that we must ensure we substantiate and document as the ultimate owner of the alternative energy system. Now, to the extent, as Tim commented, if you outsource that to a general contractor and they outsource that to subcontractors, remember that you as the taxpayer, even though you've outsourced it, are the required entity taxpayer that must substantiate and document the prevailing wage and the apprenticeship requirements. So ABC goes out with Cherry Becker's assistance, and we look at labor classifications that are basically typically needed to perform a construction of a solar farm. So there are numerous job classifications. We worked on one where there were 300 job classifications across 27,000 hours, and we needed to know that it was going to be over a several-year period. So we're looking specifically at laborers and electricians and equipment operators and iron workers and carpenters, and then even possibly truck drivers, depending upon the construction. So in this case, heavy construction, candidly, it's going to be an expanded amount of labor classifications that must be substantiated and documented. This, again, is all provided in sam.gov, but ultimately we determined through Cherry Becker's assessment that they are paying a prevailing wage as you look at the wages and you look at the total hours across the construction project, and you're looking at that on a labor classification basis. How we address and how to maintain sufficient records to meet the prevailing wage requirement, we don't have time to cover today, but I would give you an opportunity to talk with us and we can give you the details. We actually have developed, because of this policy platform, a deliverable where Cherry Becker takes on the responsibility of substantiation and documentation on a quarterly, semi-annual, and annual basis across the entire amount of the construction process. So remember, just at a high level, the records usually must include the applicable wage determination, the specifics of the labor and the mechanics of who performed the construction work on the facility by the labor classification, and the classifications of the work that were actually performed, hours worked in each classification, and ultimately the wage rates that were actually paid for that work. So it's a comprehensive documentation and substantiation requirement. So when we get to the apprenticeship side, as Tim indicated, there were a number of good faith provisions put in place. This is another policy platform that is foundational to the Inflation Reduction Act. In this case, a worker is considered an apprentice if they can be paid a rate less than the applicable prevailing wage rate, if the worker is employed specifically pursuant to a bona fide apprenticeship program, which has been registered by the Department of Labor Employment Training Administration. Very important to understand. So you go to your community college and you begin to hire those individuals. And if you haven't registered with the Employment Training Administration or the Office of Apprenticeship, then technically you would not meet the apprenticeship requirements. And remember, we're post January 30th, so we must meet those. So there are maps with state agencies that have been recognized by the Department of Labor in regards to apprenticeship agencies, and we gave you that information. But again, we're more than happy to help you evaluate this because we're just doing a very high level, almost a really tip of the iceberg as far as the documentation of substantiation requirements. So at the end of the day, ABC Solar, with Cherry Becker's assistant, determines that the state agency that is administering their apprenticeship is recognized by the Department of Labor. And we've already run in to where we've, maybe a non-client of Cherry Becker, where, oh yes, we meet that apprenticeship requirement. And then we ask the question as well, have you registered? Are you positive? And the answer ultimately becomes no, as we assist them. And then we assist them in making sure that it is in fact registered as required. So what we have determined here is this qualifies and will fulfill the 12.5% of the total hours worked on the construction project. So we've met prevailing wage, we've met the apprenticeship requirements, a little bit more detail for you there. So we move our solar from 6% base, because we've now met it, up to the 30%. So now let's think about, as Tim commented, in regards to the bonus credit. So we want to go through the analysis, and this is where we model all projects for our clients, inclusive of non-clients, to make sure, because this is changing landscape almost on a monthly basis, that you are in fact qualifying and substantiating that you qualify for the bonus credits. So again, we know we're at 30%. So Tim talked to us about the domestic content. So in this case, unfortunately, they don't use steel or iron manufactured in the US, and less than 40% of their manufactured projects were produced in the US. What we are seeing in solar specifically, and we can discuss other areas post this webinar, of course, is that a lot of the panels are still coming into the United States, predominantly from China. That was the race over a 10-year period. But now we're seeing come out of Thailand, Vietnam, et cetera. And so there's a measurement, managing expectations. There are very few manufacturers that are going to qualify for the additional 10% with respect to the domestic content requirement. However, we are aware of those that qualify, and we can certainly make those introductions. We talked about energy communities. So in our case study here, ABC helps with Cherry Becker. We go to the DOE website, and we ultimately determine if their project is an energy community or, in essence, a brownfield. And the DOE, again, provides a mapping tool, but I would be very cautious around this mapping tool, because we have already found errors in the mapping tool where we've made a phone call to the Department of Energy, and they say, oh, no, you do qualify, as opposed to the map telling us that you don't qualify. So I'm not picking on DOE. I'm just telling you that don't believe the mapping tool 1,000% or 100%. We want to cross-check it. We have relationships with DOE to do that. So we enter the solar address and the project, and the mapping tool kind of comes back that says you are indeed in an energy community and you will qualify for the additional 10% bonus credit. Remember that this must be documented and substantiated. The last item where we've now seen some additional guidance is in the low-income community, whether it's at a 10% or a 20%. ABC, in our case, our client checks, and we go through the DOE mapping tool, and it determines that that project does not qualify for these bonus credits. So we've done the next step post prevailing wage and apprenticeship requirement. We've now evaluated the bonus credits. So let's now look at where we're at. So we conclude the following. You will be eligible, or ABC in this case, would be eligible for a 40% investment tax credit rate. So we looked at prevailing wage under 2261, and we're up to 30%. We kind of walked you through that. We determined that domestic content, they did not meet the provisions of 2023-38's RevProc, so we're at 0. We documented and substantiated the energy community under 2023-29's RevProc, so we received that additional 10% bonus credit. And then the low-income community, we looked at the map, and we got the answer back based on address that there's a 0 bonus credit for either the 10 or the 20. So we set 30% prevailing wage, 10% bonus energy for this community. So we're on the ITC side of our solar alternative energy system at 40% credit. So this is where we model everything. We look at the economic benefit, if you will. So when you think about this, next slide, please. When we think about first-year incentives for an energy system. There are two types of incentives. There's the immediate benefit upon what is called connection or interconnection into the grid, unless you're going to do a microgrid or behind the meter. And then obviously there's the depreciable tax basis benefits. So in this fact pattern, we're going to spend $18 million on our solar system. We're going to put a battery pack in there on a storage so that we're looking at $2 million. On average, it's about $250 per kilowatt hour. So we're going to spend $20 million in our development of our alternative energy system. So make a long story short, what are we going to qualify for? We're going to get the 30%, 6 to 30% base credit at 5.4 million upon the connection. We're going to receive a 30% credit on the battery pack. So that's another $600,000 on our $2 million spend. And then there's the bonus credit, which we determine based on the energy community at 1.8 million. So on a $20 million project, we will receive a benefit of $7.8 million in regards to the federal credits. Now, this does not take into consideration state credits. So remember that states have piggyback, or what we refer to as state statutory adopted credits. So for example, this project actually was in South Carolina, and in their case, they received another $2.5 million. Again, the benefit is only upon a grid connection. And then we'll talk more about direct pay under 6417 of the statute and transferability. Very important provisions to be aware of as guidance has come out on that. And that was a paradigm shift when you think about the Inflation Reduction Act. So we're at $7.8 million, a dollar for dollar tax liability reduction upon the connection. Now we go to the 5-year class life asset, and we have to go through some calculations here. So we're spending $20 million, but we must reduce our basis before we apply the depreciation of bonus, class life, and additional depreciation by the 1/2 of the federal ITC. That's on the left, the 7.8 million. So we're reducing our $20 million basis by 3.9 million. So we're getting a energy system tax basis of 16.1. We are looking at the bonus provisions because we're 5-year class life. So we're at 80% in 2023. And therefore we get a $12.9 million deduction, the 80% off the 16.1. And then because we are in a half-year convention or a mid-quarter convention, we are getting the remaining basis over the next 5 years. So we estimated the 20% in the balance of the year in 2023 at another $640,000. So we're at a total energy depreciation expense in year one at $13.5 million. So we tax affect that. Let's assume we're a C Corp. We received a benefit of $2.8 million of tax savings. So you can do the math. It's 7.8 plus the 2.8. We're at a significant amount of over $10 million. So through just the federal side, we're basically subsidizing the project by about 50%. Next slide, please. So that brings us to polling question number 4. Has your company taken advantage of any of energy tax credits and incentives in the past? Yes, no, or we're planning in the future? Well, let's go ahead and post that poll out of respect to time. And the answer is no. So we stand here ready to help and model for you and assist you, not only in the selection when it comes to solar, but you may be considering production tax credits, i.e. turbines, you may be geothermal, hydroelectric, and all of the other provisions. So I want to fast forward a little bit here to be respectful to my teammate, David. So I want to go through, and David, if you'll advance us to the case study on transferability slide number 44. So remember that you are eligible, and by the way, there's a typo, my apologies, it's case, not cast study. You are eligible in the event that you do not have the tax capacity to utilize the credit under a new provision, which is referred to as the transferability provision. So we here have projected that the tax liability for ABC Solar is less than the amount of the credit generated. So the $10+ million. Now, remember that you can carry it backwards and you may carry it forwards. That was a change in the Inflation Reduction Act. So in this case, the projected tax liability was 5.3 million. Again, just using the tax credit generated at 7.8, we've got an excess tax credit of $2.5 million. So what do we want to do with it? Well, the idea then underneath 6418 is we will sell the credit to a purchaser. Usually that's about 80 to 85 cents, upwards of 90 cents, depends on the purchaser, in regards to the quote remaining credit of 1.4 million. The key here is that that sale has no income tax consequences. So we're going to sell the credit in this case for $1.26 million, or 1.19 million if we discount it by 15%. And that cash is excluded from any and all tax or income tax consequences from that standpoint. So as you can see, the paradigm shift, 6417 of the statute is a direct pay. And you'll note we asterisk, we're not eligible for direct pay. So direct pay is an incentive where the federal government will write the check to the taxpayer, specifically in very key areas. So we have a very large project that deals with an American Native tribe. So we're building and constructing that on an American Native land, and that qualifies for direct pay. In this case, we're in the 6418 provisions where we can sell the credit to a potential buyer, and we discount it by 10 to 15%. Again, all of that is a negotiation. So in the time we have remaining, I want to hand it over to my teammate David, who's going to talk to us about the specifics of the CHIPS Act overview. David, I think you're on slide 45 now.
Okay. Yep. So go to the CHIPS Act overview. Okay. So the CHIPS Act establishes an act that provides funding for the creating helpful incentives to produce semiconductors. The CHIPS Act is going to have about 52.7 billion in funding. There's going to be like three main allocations of that funding: 39 billion in semiconductor incentives, 13.2 billion in R&D and workforce development, and then an additional 500 million to strengthen global supply chains. As part of this, there's been a new Section 48D Advanced Manufacturing Investment Credit. So this credit is going to be applicable to 25% of the qualified investment in an advanced manufacturing facility. The primary purpose is the manufacturing of semiconductors or semiconductor manufacturing equipment. In general, this credit is going to apply to projects placed in service after 2022. And taxpayers can elect to treat the credit as a tax payment or, for example, a refundable credit. Okay, so the CHIPS Act funding, there's going to be 3 rounds to focus on the different aspects of manufacturing. The initial funding is seeking applications for projects that construct, expand, modernize commercial facilities for production of leading edge, current generation, and mature node semiconductors. The second round is going to be for semiconductor materials and equipment facilities. And then the last round will focus on research and development facilities. The first notice of funding opportunity, or NOFO, was released in February. And as mentioned on the prior slide, that was going to be focused on the expansion, construction, modernization of commercial facilities for the fabrication of leading edge, current generation, and mature node semiconductors. And this will include both front end wafer fabrication and back end assembly, and testing, and packaging. Okay, so the funding award. So there's gonna be three types of way the funding is given out. You're gonna get your direct funding, pretty straightforward, federal loans, and then federal guarantees on third-party loans. So for the direct funding aspect, it's expected to be about 5 to 15% of the project's CapEx in the amount of direct funding you'll get. There's not a set limitation in regards to the federal loans or the federal guarantees of third-party loans at this time. I think one important thing to note here is that your awarding might come through in various ways. So the same project might get direct funding as well as federal loans, but the total amount of funding you're going to receive is not expected to exceed 35% of the project's CapEx, but you can get it in various forms, not just one or the, Okay, so there's a 5-part application process for the first NOFO, and let's go through that briefly. So we have a statement of interest, which is just a brief description, overview of the project. The second part, we're going to do the pre-application. So this is optional, but this is really where if you want to provide more detail that didn't really fit into your initial statement of interest, this is where you would kind of put that. And then as we move forward, you get the full application. So this is where you're going to have all of your technical analysis, details of the projects where they can really dig into and see, what the project is about and what you're planning on doing. We move to the next step. It's going to be your due diligence. So if the CHIPS office determines, hey, this looks like a good project potentially, they're going to start a very significant due diligence process that they're going to work through. And then the last step would be the award preparation issuance. So let's say, it's complete, the due diligence, everything's good to go. They're issuing your funding, but you're not going to get that funding all at once. It's going to be tied to milestones. So you're going to get the funding in increments just to prove that you're moving forward and completing certain deadlines and goals. That way, they know you're actually going through with the proposal. So the application process, there's really 6 things that this program was looking to do. And the 6 things that really have to be addressed in your application for you to potentially receive, this funding. So the 6 things are economic and national security, commercial viability, financial strength, project technical feasibility and readiness, workforce development, and broader impacts. And some program updates. So the full applications started being accepted on June 26th of this year. One important update is the scope of the first NOFO has been expanded for applications for the construction, expansion, and modernization of commercial facilities for semiconductor materials and manufacturing equipment facilities. If the project investment requires $300 million, just note that was initially going to be part of the second round of funding, but now they've included in the first for those projects where the capital investment is greater than $300 million. And the new scope will be accepting applications beginning last week on September 1st, and then the full applications will be available to be submitted for acceptance on October 23rd, 2023. And that brings us to our last polling question of the day. I should probably read this out. So would you like to learn more about how to take advantage of the energy tax credits or the CHIPS Act? Sorry, I should have read that from the beginning. My apologies there. Let's see the results. Do we have the results of that poll? Okay, it looks like we're not gonna get the results of that poll, I guess. I'm sorry about that. Okay, so that will conclude the slideshow. I'll turn it back over to Ron to
All
finish
right,
us
thank
off.
you. Nice job, Tim, as well as David. I want to thank all of the attendees. We always want to underpromise and overdeliver. It's about 2:59. We would encourage you to reach out to us. Here's our contact information in regards to any questions or further questions. I believe I have answered all the questions in the chat box. As I had a brief moment to do so, there were a couple that would need more discussion, for example, on the not-for-profit side. So we thank you for attending today. Hopefully we look forward to interacting with you. So you'll know there was over 630 registered attendees. So energy has a lot of energy. Thank you so much, and you all have a great day.